Here's a strange fact about money. Two people can invest the exact same amount every month, get the exact same rate of return, and one of them can end up with less money at the end, even though they put in 3 times as much cash over their lifetime. That's not a trick, it's not a hidden fee. It's not luck, and it's not a better stock pick. It's just math. And once you actually see how it works, it changes the way you think about every single year you wait to start. So let's walk through it slowly and see exactly where that money goes. Picture two investors. We'll call them Investor A and Investor B. Neither of them is unusually lucky. Neither of them picks better stocks or times the market cleverly. They both get the exact same average return, 7% a year, which is a reasonable long-term estimate for a diversified stock market investment, the kind you get from a simple index fund. Investor A starts at 25. Every month they put in $200. They keep this up for exactly 10 years, until they turn 35. Then they stop completely. No more contributions, ever. They just leave the money sitting in the market, untouched, all the way until they retire at 65. Investor B waits. Life gets in the way. Maybe it's debt, maybe a career that hasn't taken off yet, maybe just not feeling ready. They start at 35, the exact age Investor A stopped contributing. But once Investor B starts, they don't stop. Every month, the same $200 for the next 30 years, all the way to 65. Now here's the question worth sitting with for a second. Who ends up with more money at 65? Investor A only ever contributes for 10 years. Investor B contributes for 30 years, 3 times as long. Add up the actual cash each of them puts in over their lifetime, and Investor B has personally handed over $72,000. Investor A has handed over just $24,000, a third of the amount. And yet, at 65, Investor A finishes with roughly $252,000. Investor B finishes with roughly $227,000. Investor A wins by about $25K while contributing $48K less out of their own pocket. They did less work, wrote smaller checks for a shorter stretch of life, and still came out ahead. The reason comes down to one idea. Compound interest doesn't add up in a straight line, it multiplies. And multiplication needs time to do its work. When you invest money, you're not just earning a return on what you originally put in. You're earning a return on your original money, plus the returns it already made, plus the returns those returns went on to make. Each year builds on top of every year before it. That's the actual definition of compounding. Growth on top of growth, stacking indefinitely. Think of it like a snowball rolling down a long hill. At the top, it barely picks up any snow. It's small, and each rotation only adds a thin layer. But the further it rolls, the bigger it gets, and the bigger it gets, the more snow it picks up with every rotation. The growth isn't steady. It accelerates. And the length of hill your snowball gets to roll down is exactly how much time it has. Here's the part almost everyone underestimates. In the early years, compounding looks slow, almost boring. A few extra dollars here, a few dollars there. It's easy to look at your investment account after 2 or 3 years and think it's barely doing anything. But the curve isn't a straight line, it's exponential. It bends upward, and the later years of that curve absolutely dwarf the early ones. The catch is, you only get access to those later years if you started early enough for them to exist at all. So when Investor A invests from 25 to 35, those contributions don't just sit there for 10 years. They sit there for 40 years, because Investor A leaves the money invested all the way to 65. Every single dollar put in during that first decade gets 4 decades of compounding behind it. Investor B's money never gets that kind of runway. The money Investor B puts in at age 35 only has 30 years to grow. And the money they put in near the end of their run, at 63 or 64, barely has any time to compound at all. It's practically just sitting there. It hasn't had a chance to become anything more than what it started as. So this was never really a race about who invests more money. It's a race about whose money has more time to compound. And in that race, time outperforms money. Let's slow down even further and look at just Investor A's 10 years of contributions in isolation. Over that decade, they put in $24,000 total. By the time they turned 35, thanks to compounding already working quietly in the background, that $24,000 has grown to roughly $33,000. Now that $30,000 sits completely untouched for another 30 years. At 7% a year, money roughly doubles every 10 years. So over 3 decades, it doesn't just grow, it passes through several doubling cycles, one stacked on top of the last. That's the entire mechanism behind how 33K quietly becomes more than 250K without a single additional contribution ever being made. Investor B never gets that multi-decade runway on the bulk of their money because they started 10 years later. They're working harder, in a very real sense, writing that $200 check for 3 times as many years, but time simply isn't on their side the same way. This idea has a name in personal finance, the time value of money. It's not a prediction, and it's not a strategy someone invented to sell you something. It's a mathematical property of compounding itself. and it shows up the same way no matter which exact numbers you plug in. It's worth addressing the objection that probably crossed your mind. Doesn't this just mean you should always invest as much as possible, as early as possible, forever? Isn't more money always better than less? Of course, more money invested is never a bad thing on its own. But that's not really the lesson here. The lesson is narrower and honestly more useful. The timing of a contribution changes its eventual value more than most people expect, sometimes more than the size of the contribution does. A modest amount invested in your 20s can genuinely outperform a much larger amount invested in your 30s or 40s, simply because of how many doublings it gets to pass through before you actually need it. That means the real cost of waiting isn't just, I'll end up investing less overall. It's that every single year of delay permanently removes one of the biggest, most productive doublings from the far end of the curve, the ones your money would have experienced right when it was largest and growing fastest. You can't buy that decade back later, no matter how much extra you're willing to contribute. This isn't really a story about two hypothetical people with tidy round numbers. It's a story about what a single year of delay quietly cost you, invisibly, without ever showing up as a bill or a fee, without a moment where you actually see the money leaving. If you're in your 20s, the money you invest today is doing something money invested in your 40s simply cannot do. It's buying decades of compounding that literally cannot be purchased back later at any price with any amount of extra cash. If you're past that point already, this isn't a reason for regret. It's actually the opposite lesson. If 10 years can make this much difference, then today is the earliest day you have left for the rest of your life. The version of you at 60 will look back on whatever you invest this year the exact same way we've been looking at Investor A's first decade, as the years that had the most time left to grow. One thing before we wrap up, 7% a year is a long-term average, not a guarantee. Real markets rise and fall, sometimes sharply, and no investment grows in a smooth, predictable line the way our example did on a whiteboard. Some years will be down years, occasionally by a lot. But the underlying principle, that time in the market matters more than the size of a later contribution, holds regardless of exactly how bumpy the road is in any given decade. So the takeaway isn't simply invest more, it's invest sooner. Because the version of your money that gets the most decades to compound will always have an advantage that no later, larger contribution can fully make up for. If you like this video, please like, comment, and subscribe. It really helps the channel, and I'll see you next time.